Welcome back to the Deep Dive. We're putting on our Talk Tickers hats today.
We have to.
Because we are looking at an absolute beast of an earnings report. SoFi Technologies, ticker SOFI, and their Q4 2025 results.
And, if you just glanced at the headlines, you would think it was the party of the year.
Oh, absolutely. Champagne flowing on Wall Street, ticker tape parades, the whole 9 yards.
It was a total victory lap on paper. But then you look at your trading screen at 4 p.m. on Friday.
And it looked more like a crime scene, a total bloodbath.
Yeah.
This is the absolute classic beat and drop.
Mm-hmm.
The company posts its first ever billion-dollar quarter. They beat on earnings, they raise guidance, and the market just sells it. The stock goes down over 6%.
Yeah.
Help me make it make sense. Is the market just broken, or is there something buried in the footnotes that spooked everyone?
It's not broken, it's just ruthless. And honestly, this was a liquidity event. We need to unpack this because there is a massive, massive gap between the business performance, which was, objectively very strong, and the stock performance, which was a textbook sell the news event. We're going to get into their big pivot to this capital light model and the huge bet they're making on crypto.
It's just a fascinating setup. You have the CEO, Anthony Noto, out there talking about unprecedented results, using his football metaphors like fresh horses.
He loves those.
And then the tape, the actual stock chart, tells a completely different story. So let's start with the top line. What were the headline numbers that triggered all this?
Okay, so the big one, the one everyone's talking about, is revenue. GAAP net revenue hit $1.025 billion.
That's up 40% year over year.
40%. And stop there for a second. That's the first time they've ever crossed the billion-dollar quarterly barrier.
That's a huge psychological threshold, right?
Yeah.
It feels like they've graduated from, scrappy fintech to something more.
It's a graduation moment. Exactly. You don't accidentally make $1 billion. And crucially, they weren't just burning cash to get there. They were profitable. GAAP net income was $173.5 million.
Okay, and the EPS?
Adjusted EPS came in at 13 cents. That beat the Wall Street consensus of 12 cents.
So a penny beat, that's good, but, a penny beat usually gets you a polite nod, not a 6% haircut.
True. But the number that really caught my eye, the institutional grade number, was the adjusted EBITDA. $317.6 million.
Which is a 31% margin.
A 31% margin. And you have to remember, management's long-term goal was to hit 30%. They just blew right past it and way ahead of schedule.
So the operating leverage is really starting to kick in. They're not spending $1 to make $1 anymore.
They're spending $1 to make $1.30. And looking ahead, they are not slowing down.
Right, because usually you'd expect them to sandbag a little, guide conservatively for 2026.
Not at all. The guidance is aggressive. They're calling for adjusted net revenue of about $4.65 billion next year.
That's another 30% growth, roughly.
Another year of 30% growth. And they're targeting adjusted EPS around 60 cents for the full year. Noto is basically saying 2026 will be another year of unprecedented results. The foot is firmly on the gas.
Okay, let me get this straight. Beat on revenue, beat on earnings, margins are better than promised, and they raise guidance. And yet, the stock.
And yet, the reality check. Friday morning, pre-market, SoFi was indicated up 7.6%. It was trading around $26.33.
The bulls were getting ready to run.
They were ready to party. By the close of trading, it was at $22.81, down over 6%. That is a massive, massive intraday swing.
That's a rug pull. That is what that is. Why does that happen?
It feels like one, but you have to zoom out a little. The stock was up almost 135% over the last year going into this report.
Okay.
And up nearly 20% in just the last month. It was priced for perfection.
Ah, the classic good news trap.
Exactly. When a stock is priced for perfection, even great results can sometimes just be good enough to sell into. The algorithms see all the retail buyers chasing the good news.
And they use that liquidity to get out.
They use the dumb money as exit liquidity. It's not about the fundamentals in that moment. It's just pure market mechanics.
Okay, so a classic profit-taking event. But I want to get under the hood of the business itself because there's a big strategic shift happening here. We keep hearing this phrase, capital light. What does that actually mean?
This is maybe the most important part of the whole story. It's their loan platform business, or LPB. For years, the bear case on SoFi was They're just a bank holding a bunch of risky personal loans.
Right. If the economy turns, they're in trouble.
Exactly. The LPB is their answer to that criticism. They are shifting from just holding the loans to manufacturing and then selling those loans.
So they're becoming more of a loan factory, originate to distribute.
Precisely. In Q4, the LPB generated $194 million in adjusted net revenue. If you annualize that, you're looking at a pace of almost $775 million.
That's a real business.
And their total fee-based revenue, which is the key here, hit $443 million. That's up 53%. So they are successfully moving away from just collecting interest payments over time.
Which is just a smarter model, right? Fees are cash in the door today. Interest takes years to collect and carries risk.
It carries credit risk and duration risk. If you sell the loan for a fee up front, you've already booked your profit. The default risk is, well, it's someone else's problem.
But the big question is, are people actually buying these loans? Is there a real market for SoFi's paper?
That was the million-dollar question, and the answer seems to be a huge yes. They originated $7.5 billion in personal loans, but here's the key detail. They sold $100 million of those loans in whole loan form.
Meaning they sold the entire loan, not just pieces of it, to an institution.
Correct. To an asset manager or another bank, and they sold it at a blended execution of 106.5%.
Whoa, 106.5. Break that down. That means the buyers paid a premium for the loans.
A significant one. For every $100 of loan value, the buyer paid SoFi $106.50.
That is a massive vote of confidence in their underwriting.
It completely validates it. It tells you that big money institutions are hungry for this asset class. And management was very clear. They are not forced to sell. They have the capital to hold them. Selling is a choice. It's what they call optionality.
Okay, so they have the option to hold or sell, depending on what's best. And they mentioned a new partner for this LPB and more in the pipeline?
Yes, several others at the final term sheet stages. So this isn't a one-off deal, it's a repeatable business line.
Okay, so the lending business is becoming a fee-generating machine. Let's pivot to the tech side. Because for a long time, the bull case was that SoFi was becoming the AWS of fintech, with Galileo and Technisys.
Right, the tech platform.
But there was a headwind there in this report.
There was the churn. The tech platform revenue was $122 million, up 19%, which is decent, but they lost a very large client.
Do we know who?
They didn't name them, but it was a big client that fully transitioned off the platform in Q4. This was expected, they had telegraphed it, but it still leaves a hole they have to fill in 2026.
It definitely adds a little friction to that growth story.
It does. It shows the platform isn't quite as sticky as maybe some bulls had hoped.
And it feels like Noto is kind of looking past that and betting the entire farm on something else entirely. He's talking about the crypto supercycle.
This is where the call got really interesting. I mean, usually bank CEOs run screaming from the word crypto.
Especially now, post-FTX.
Right. Most of them pretend it doesn't exist.
Yeah.
Noto is diving in head first. He's framing SoFi as being uniquely positioned for both the crypto and the AI supercycles.
And they launched their own stablecoin, SoFi USD. Now, I see stablecoin, and my first thought is Tether or USDC. Does the world really need another one?
The world is saturated with offshore, unregulated stablecoins. It is starving for onshore, fully regulated ones. That's the key distinction.
And SoFi is the first national bank to issue one on a public permissionless blockchain.
Unpack that for us. What does public permissionless mean in this context? We've heard of JPM coin. How is this different?
JPM coin is a walled garden. It only works inside JP Morgan's private system. It's basically an internal spreadsheet. You can't take JPM coin and use it in the real crypto world. Public permissionless means SoFi USD can actually live on the open internet, on Ethereum, on Solana. It can interact with DeFi. It's not trapped inside SoFi's little garden.
But with the safety of a national bank behind it.
That's the entire pitch. It's backed one-to-one with actual cash held in a Federal Reserve master account.
So zero duration risk. No weird commercial paper or sketchy assets, just dollars at the Fed.
Exactly. It is arguably the safest digital dollar that exists. They want to be the regulated bridge between the old financial world and a new one. They want to be the infrastructure.
And they're already using this for their SoFi Pay product, right?
Yes, expanding to over 30 countries, Mexico, India, Brazil, across Europe. Using the blockchain to move money across borders faster and cheaper than the old SWIFT network.
So the vision is to become the bank for any business that deals in both fiat and crypto.
That's it. While all the other banks are running away from crypto clients, getting scared by regulators, SoFi is running toward them. They are making a huge bet that they can become the bank of choice for the entire digital economy.
It's a bold play. If they're wrong, it's a lot of wasted R&D. But if they're right.
If they're right, the upside is enormous.
Righty.
But let's bring it back to earth for a second. All this fancy tech is great, but you still need deposits. How are the actual member numbers?
The flywheel is definitely spinning. 13.7 million members. That's up 35% year over year. They added over 1 million new members in Q4 alone.
And the deposits?
Deposits are up 4.6 billion in the quarter. Total deposits are now 37.5 billion.
That's a lot of cash coming in the door. But they are paying up for it with that high-yield savings account.
They are, but their net interest margin, their NM, is 5.72%.
Which, for anyone listening, is the spread between what they pay you for your savings and what they earn on loans. And 5.72% is very healthy.
It's very fat. And they made a really interesting counterintuitive point here. They argued that falling interest rates actually help them.
How does that work? I thought banks want higher rates.
They do, but SoFi's advantage is its low cost of funding. As rates fall, other banks have to slash the rates they offer on savings accounts. SoFi, because their lending is so profitable, can afford to keep their savings APY higher for longer.
So they become a vacuum for deposits. As everyone else cuts, they stand out.
It's a customer acquisition weapon. Come for the high yield, stay for the whole ecosystem.
We have to touch on the bear case, though. It always comes back to credit. I saw their personal loan charge-offs, the NCOs, ticked up to 2.8%. Is the consumer starting to crack?
This was the most nuanced and probably the most misunderstood part of the call. Yes, the headline charge-off rate went up. Management's defense is that it's an issue of mix, not credit deterioration.
Okay, mix always sounds like an excuse. Unpack that for us.
Think of it like this. Brand new loans almost never default right away. Older, seasoned loans are where defaults naturally start to happen.
Okay, makes sense.
Because SoFi sold so many of their brand new loans via that LPB strategy, the loans left on their balance sheet were, on average, older.
So the pool of loans looks riskier just because they sold off the safest ones. The denominator changed.
Precisely. They argue that if you adjust for that seasoning effect, the underlying credit performance actually got better. But you still have to look at who these borrowers are.
Are they subprime?
Not even close. The weighted average income is $158,000. Average FICO score is 746. This is a prime, high-earning customer.
Okay, so let's put it all together. Record revenue, smart pivot to fees, huge crypto bet, solid member growth, but the stock gets hammered by the disconnect.
Valuation and positioning. Simple as that. The stock had run 134% in a year. The market looked at that 30% growth guidance for 2026 and basically said, yeah, we already priced that in.
You did what we expected. Now what?
Now show me a positive surprise. And the results were great, but they weren't a shock, and there are still risks. That tech client loss leaves a hole. The LPB business has to keep finding buyers for loans. If that market dries up, they're stuck holding the bag.
And management is just ridiculously bullish, not assigning off with fresh horses we ride. He thinks they're at the start of something huge.
He's a promoter, and he believes in the brand. Citing Josh Allen, TGL Golf, he thinks they're hitting escape velocity. The market is just more cynical. It's saying, show me.
Which brings us to my favorite part of the deep dive. We've looked at the quarter. Now let's look at a potential future.
It's time for our This Is Not Financial Advice segment.
Full disclaimer. We are not your financial advisor. This is purely for entertainment and educational purposes. Do your own diligence. But if we were at a hedge fund pitching an idea based on this, what's the trade?
Okay, so picture it. We're in the conference room. The PM is staring at his screen, looking annoyed. I slide a deck across the table. The title is The Regulated Crypto Rail Arbitrage.
I'm listening. That sounds expensive. What's the thesis?
The thesis is that the market is pricing SoFi like a regular consumer bank with credit risk. It's looking at FICO scores. It is completely, totally missing the stablecoin infrastructure play. The market thinks they're building the next Wells Fargo. I think they're building the Visa of stablecoins.
Go on.
Noto is building a vertically integrated system. He's got the bank charter, the Fed master account, and the blockchain tech. He can issue his own digital dollar, move it around the world instantly, and settle it himself. He cuts out all the middlemen.
So what's the trade structure? How do you play it?
It's a pair trade. You go long SoFi. But you don't buy the stock. You buy the 2027 LEAPS.
The long-term call options. giving yourself a couple of years for the story to play out.
You need time. You need time for that EPS to grow to 60 cents, and for the crypto narrative to take hold, and for the short side of the trade.
What are we betting against?
You short a basket of two things. One, the legacy remittance companies like Western Union, and two, here's the kicker, you short the unregulated offshore crypto exchanges.
Ooh, spicy. So you're betting that regulation is coming for the offshore players and blockchain efficiency is coming for the old world money movers.
And SoFi is the only one left standing with a government-approved bank charter. That's the moat.
That's the real moat.
If that crypto supercycle Noto talks about actually happens, SoFi isn't just a bank earning a spread on loans. It's a tech company taking a tiny slice of trillions of dollars in transactions. That gets you a tech multiple, not a bank multiple. And the stock doesn't trade at $22, it trades at $50 or higher.
That is a fascinating high-risk, high-reward way to frame it. Again, not financial advice, but it forces you to ask the right question. Is this a bank, or is it a tech company with a banking license?
And if you're a bull, you have to believe it's the latter.
So, wrapping up, SoFi delivers a landmark quarter. Management is celebrating the market sold it off.
The company is aggressive, they're capitalized, they're pivoting hard. The stock price today might just be noise, or it might be a warning that the valuation is capped until they can prove that massive crypto bet actually pays off.
Anthony Noto says they're just getting started. The market says, prove it.
Keep your stops tight and your research deep.
Thanks for listening to The Deep Dive. We'll see you on the next print.
Over.